For 6 decades, a single, highly coordinated alliance has dictated the terms of the global economy by tightly manipulating the supply of crude oil. This animated diagram breaks down their true scale. The member nations of OPEC control more than half of the world's total oil production. By opening or closing their taps together, they can inflate or crash the price of the energy that powers the planet. After nearly 60 years as a core member, the United Arab Emirates has officially announced it is quitting the oil alliance. The UAE is one of the oldest members in the group's history, pumping roughly 3 million barrels daily, making them an absolute heavyweight. Losing a producer of this size deletes millions of barrels from the group's collective leverage. Without the UAE's volume in the mix, the cartel loses its mathematical ability to dictate global markets. Nations like Qatar and Angola have walked away from OPEC recently without breaking the system. The UAE's exit is different because of the specific role they played in market stability. This spare capacity is an emergency buffer. The schematic shows a closed tank holding 1.5 million barrels. If crisis strikes, the UAE can open its tanks to stabilize prices. Zooming out, the UAE's spare capacity dwarfs the combined buffers of almost every other member nation. The UAE held 1.5 million barrels of emergency reserves. With that buffer gone, the cartel has lost its primary shock absorber. The next time a global crisis hits, OPEC will lack the physical crude necessary to prevent prices from spiraling out of control. Over the last several years, the UAE has poured billions of dollars into upgrading its extraction infrastructure. They built massive desert facilities, optimizing their technology to pull crude out of the ground at maximum efficiency. Because of those upgrades, the UAE has drastically lowered its break-even price, the minimum price to sell oil and still make a profit. Look at this bar chart. The UAE can pull oil from the ground at roughly half the cost of Saudi Arabia. Watch the global price trend line as it plunges. Even when market crashes force higher-cost producers into massive losses, the UAE remains comfortably profitable. But efficiency means nothing if you aren't allowed to sell. OPEC enforces strict production quotas on all its members. These limits act as a forced speed limit, legally barring the UAE from turning on its new billion-dollar infrastructure and pumping at maximum volume. The UAE plans to aggressively pivot its economy away from fossil fuels and into tech, global finance, and renewables. They need massive amounts of immediate cash to fund that transition. Staying loyal to the cartel meant leaving billions of dollars of fully accessible, highly profitable oil locked in the sand. The math alone made the alliance difficult, but regional politics made it impossible. Saudi Arabia operates as the undisputed leader of OPEC, pushing the group into policies that serve its own national interests. The Saudi strategy relies on tightly restricting supply to artificially inflate the price of a barrel. The UAE requires the exact opposite. They want to flood the market, drop the price, and capture maximum market share through volume. This economic friction ignited a geopolitical fire during recent regional conflicts. Iran-aligned militants launched direct drone and missile strikes deep into UAE territory, targeting their economic hubs. When the UAE looked to its Gulf allies, including Saudi Arabia, for a coordinated military response, they were met with silence. The lack of defense signaled a breakdown in the alliance. Relying on Saudi-led consensus failed to protect UAE infrastructure, transforming the partnership into a security liability. Quitting the OPEC alliance entirely severs that massive security liability. The UAE has decoupled its foreign policy, its military security, and its main revenue stream from its neighbors. A major producer operating outside the cartel shifts the global balance of power. The leverage moves immediately from the sellers to the buyers. Take a country like India, which imports 85% of its crude oil. They can bypass the cartel entirely. Instead of paying inflated group prices, massive consumers can negotiate cheaper, direct bilateral deals with a suddenly unrestricted UAE. In the short term, this means relief at the pump. A free pumping UAE will rapidly increase the global supply of crude, driving prices down for everyday consumers. The long-term reality is entirely different. Look at this projected line graph. Without the UAE's 1.5 million barrels acting as a reliable shock absorber, the market loses its safety net. When global supply is disrupted, consumers are exposed to extreme price swings, spiking and crashing without the cartel's buffer to contain the chaos. Saudi Arabia is now stranded. To keep prices stable and prevent the rest of the alliance from dissolving, the Saudis will have to drastically cut their own production to make up for the UAE's extra output. They are left carrying the entire weight of market management alone. The UAE has proved that prioritizing national infrastructure generates higher returns than maintaining group quotas. With the world's third-largest producer now operating independently, the collective leverage that defined OPEC for 60 years has reached its breaking point.